Good evening, everyone. Welcome. Thank you for joining me tonight from wherever you are in Canada. Today I'm in Toronto. I'm normally based in Edmonton, and my name is Steve, and I am the partner at Finngo Bookkeeping and Tax. And Finngo is a company that specializes in modern solutions for real estate investors and all the services that we provide tailored to the needs of investors. And the reason is I'm an investor myself, so I'm trying to create a firm that would meet my needs and my expectations. I have firsthand experience and I understand the pains that you would be going through, and I know all the information that is needed to have a successful real estate business. Today's webinar, we're going to focus on bookkeeping and specifically on bookkeeping for rentals which you own in your personal name. And my goal is to highlight the reason why having an REI-focused bookkeeper is important, some of the services that we can provide, and how you can save money. I think you all know this guy. We have Wayne Hillier in the room from REI Masters. I'm so happy he's part of this as well, and that he is endorsing this product. He is joining us today as well. So thank you, Wayne.
Yeah, thank you so much for having me. How's everybody doing? Everybody doing good? Yeah? I can't hear you. I said I can't hear you. It's good to be here. It's good to be a part of this. And this is something I'm really, really excited about, and something that Steve and I have been talking about for quite some time now. And I think I've had a lot of conversations with many of you guys as well about this, surrounding this topic, around this topic of bookkeeping and real estate investing. And I just to show of hands, actually, just real quickly here, let me change my view so I can see you guys. Just to show of hands, how many of you guys have rental properties? Oh, nobody's got their cameras on. You can put it in the comments too. Let me know. How many of you guys got rental properties? I got rental properties. Yeah, Patrick's put his hand up. Oh, you can do that hand thing too, or you don't have to turn your camera on. You can just turn that hand thing up. That works as well. That's awesome. That's great. Okay. The reason I ask is, well, next question is, how many of you guys have a professional bookkeeper on your power team? Some. I get it. It's, you know what? I get it. Interest rates are high. Nobody saw that coming in 2022. Nobody did. And as well, cash flow is difficult as well because of those interest rates. And, this seems like it's a today problem. It's like, oh, it's just once cash flow increases, I'll totally get a bookkeeper again for my power team. It's not a today problem. This has actually been going on for quite some time. And, I've been around for over a decade in this industry, and I've seen things change and I've seen things stay the same. And one thing I remember when I was first getting started, which is like learning, you know what I mean? Like, most of you guys listen to podcasts, you watch YouTube videos and stuff like that. For me, it was, man, I sound really old right now, but for me, this is before podcasts. So like nobody had any real estate investing podcasts that time. I was reading blogs from like realtor websites. And I was also like going to webinars, seminars, and reading books. And I remember whenever I was reading those books or going to those, seminars, it was always, everybody said, we're talking about your power team. You talk about your realtor, you talk about your mortgage broker, you talk about your lawyer, you talk about your handyman, contractors, home inspector, and bookkeeper. Like bookkeeper and tax professional were always in there. And I remember reading that. It was like everything. And even when they were analyzing deals, they factored in the cost of, and we're just talking about bookkeeping today, right? Where they factored in the bookkeeping costs into the cash flow analysis. And at that time, it was like 25, 30 bucks an hour. Now, obviously, since then, it's gone up a little bit, but just inflation, right? But somewhere along the lines, cash flow used to be really great. I don't know if some of you guys have been investing for a long time. Let's talk about early 2000s. Yeah, like when things were really, really good. Even in like my market in Alberta, the mid 2000s, some real good cash flow, high rents, low prices, right? And everybody had it. And then something happened around 2008, and then some other things happened in between, the 15 years following that. And suddenly, as the cash flow starts to diminish and everybody wants to put less and less money down and financing gets more and more difficult, people started cutting costs. Nobody has a property manager anymore. Poor property managers. Anyone ask, like, hey, does anyone have a recommendation for a property manager? Nobody has one. Want to know why? Because nobody uses one. Same thing. Anyone says, hey, anyone got a bookkeeping referral? Nobody, because nobody uses one. Because everybody's trying to cut costs. They're all romantic about, like, I still want this property. I got to make it work. How do I make it work? Where can I shave off the cost? Well, I can get some really cheap back alley insurance. I could maybe avoid paying property taxes. I'm going to definitely cut out the property manager and bookkeeper. Can't afford that noise. So that's basically what everybody's done. And then they move it, and everyone's justification for that is, oh, it's just bookkeeping. I can just a spreadsheet. All I need to do is just keep my receipts and pass it off to my accountant, right? Yeah, a little bit more than that. And you guys are going to learn a lot about that today. And I remember when I first reached out to Steve, I was telling him the story. I'm like, I just don't understand why nobody uses bookkeepers. And I'll admit, I am one of those guys that didn't. And I'll tell you from firsthand experience, holding off for as long as I did made it incredibly worse. It's much easier to make the transition when you got 1 or 2 properties. Try making that transition later on down the road when you got many properties. It's like you have to redo your whole system. Like it's not an easy transition. But Steve here has actually got a really cool product for real estate investors, and he's going to make that transition a lot easier than it was for me when I was originally trying to do it. And he's going to show you as well. I know your first thoughts are, I don't have the room in my cash flow. I can't afford it. But what you're going to realize is that you may be saving 30, 35 bucks, 40 bucks a month or whichever by doing it yourself. What you're going to realize is that it might look like you're saving money right now, but you're actually paying significantly more. You just don't realize it. It's just ending up on your tax bill later on. They're just charging you for it later on after the fact. And it's almost like it's ignoring something that's right in front of you. And we're going to share that today. And hopefully Steve's going to make it really super simple and an easy transition for you and show you how much money you're actually going to save by bringing on a bookkeeper onto your power team. This is, I would say, one of the first of many conversations that I hope is going to be had in this industry. My goal this year is to change the industry standard of what is expected as far as how to operate your rental property business, and also how cash flow analysis and performance should be created. I think that we should be factoring in this cost and then finding the deals that support it, and not finding deals and then trying to make it work by cutting costs. So we're going to try and change the industry standard on this. And I hope that this is the first of many conversations, because I haven't seen or heard anyone else talking about this in the industry. So very excited for this. Thank you guys so much for joining. We have over 100 people registered for this event. Not everybody's here yet. And I get it. It's Friday. It's a long weekend. So I'm going to quit blabbering on, and I'm going to pass it off to Steve. And if you guys are coming in late or you're leaving a little bit earlier, we're hoping to get this recording off to everybody that registered, so you can all catch up on it. And Steve, take it away, man.
Thank you, Wayne. And yes, the session will be recorded. So hopefully for anyone that misses it, or in case I go too quickly through some of the information, you could just go back and rewatch it to kind of see what you've missed. I would like to add on a couple of little things to what Wayne said earlier. One is that people did start to cut their bookkeepers, but also there's not that many highly qualified and good skilled bookkeepers out there. The accounting profession is very short-staffed. And very often, even if there is someone that is kind of good and someone is using them, they might not be passing that information to you because they're probably already overworked, and it will be very difficult to get on and become a new client essentially somewhere else, similar to many other industries in Canada. So luckily, like, we've tried and find a way to work around that. So let's get started and talk about why we are having this problem. I think one of the main issues that investors experience, and I worked through so many files this tax season, and the thing that kind of stood out to me is misallocated expenses. So misallocated expenses are very common. And what I mean by that is expenses which normally I would want to see them in your current expenses. So that way you're able to claim in the current tax year and be able to maybe get a discount on your taxes or maybe a refund if in case it kind of brings it down to that point. A lot of times they get kind of bulked up with other rental costs that you do, and they get added to your adjusted cost base, or they get added to your capitalization essentially. So when you're not tracking things properly, it is very easy to, during tax season to drop off a large package to your accountant and then, they see a bill of like 60 grand or 75 grand. They don't have time to go through it. So as a result, they just take the entire number and they capitalize it. When essentially you could potentially break it down and if out of 60 grand you could take 10 or 15 or even 20 out of it and claim it in the current year, that could make a huge difference for you. And I do have some case studies that we're going to talk about later that showcase that actually. The next item would be missing expenses or not having backups. Very often we use our spreadsheets, we input the information, and maybe we do have backup, but it is in a shoebox. And 5 years go by, and when CRA comes knocking at your door and asking for information, you either cannot find it, or perhaps it was on receipts which faded, or it is disorganized, like it is still a shoebox. And even though you have the Excel, that's not good enough for CRA to just accept it. So maybe for the year that you did it, it's fine. But what happens, 3, 4, 5, 6 years down the line, so you want to try and make a way that the information is well organized, easily accessible, you have backups of everything, and ideally, if possible, digitize, in my opinion. We also have some risk of review or audit. If you have a partner and one person is claiming a certain set of numbers and the other person is claiming something that is slightly off, both of you think you're right, but CRA will see those two returns and be like, which one is it? It can be both, right? One of them only is. So guess what? Like, we are going to send a review letter, and those do take time. So you would receive a letter. It's going to ask you many questions about the specific situation. Then you will have to answer it. You're going to have to go back and forth with CRA to figure out what is the final number, and then go through a reassessment process, and then hopefully you'll be done with it. If they uncover more things, they could start going and digging into it deeper and go back and review previous years as well. So definitely something that is quite risky and you want to avoid. So having good bookkeeping and being organized well and sharing that information between the number of partners that are part of the deal makes the process flow a hell of a lot smoother. We also have your opportunity costs. And opportunity cost means what could you be doing instead of bookkeeping that could make you more money? Maybe bookkeeping takes you an hour a month. That's 12 hours a year. So potentially, instead of doing bookkeeping, you could be doing joint venture meetings. And if you could convert 1 out of 12, that could be a lot more money than what you would be paying for bookkeeping. So that is time that you could be spending doing something else. That's your opportunity cost. In some people's point of view, opportunity cost could also be time with family, because in the end of the day, as investors, we're here doing this for a reason. And sometimes the reason is that we have more time with our family, so that we are more free to travel or to do things for ourselves. So being stuck into that grind and, doing things that are kind of the minutiae and the little things is possibly kind of like a waste of time. You could outsource that. You could get somebody else to do it for you. And one of the last points I have for this is we sometimes want to look more professional in front of potential joint venture partners. If we tell them, hey, like, we use a third party that kind of prepares all our numbers, everything is, screened by two people, usually a preparer, then there's a reviewer, then it comes to us as the managing partners, we present it to you, then that kind of looks pretty good. So potentially you could be closing more deals if you had a third party solution that looks very professional. So this kind of leads me to the first case study I want to tell you about. This tax season, actually, I had a long-term client to call me, and he said, "Hey, Steve, I have a friend. He's been investing in real estate, and he just told me about some stuff in his tax situation, and I really think that you need to talk to him." So I got on the phone with that gentleman, and we went over the information. So he told me that he purchased a rental property in 2022, towards the end of the year. And the property was in a very rough shape. So he had to do some major renos. In fact, it costed him about $150,000 to do the renos for that property. Obviously, he couldn't have done it all in 2022, so it did spill over in 2023. And he said that just because there was nothing available, or the property was not available for rent in 2022, he just didn't do anything. He didn't report none of his expenses. So everything was in 2023. He wanted me to deal with that and just report it in 2023. So we looked at the file, and we had to go back and forth with him quite a lot, because $150,000 of expenses is a lot of various things that are in there. We went through it from top to bottom. We asked him questions. We asked for source documents. And in the end, we were able to determine that he was eligible to claim quite a significant chunk in the 2022 year. So what we ended up doing is we had to offer him the option to refile 2022 and then to file 2023. He agreed. We got everything ready. We went on our computers. He signed off the documents. I'm there clicking file, and error. You cannot file it. And I'm like, oh my God, like what's going on? Turns out the 2022 year he originally had done was done by paper. So as a result, we couldn't electronically file. So again, we had to go back. We had to print off everything, send it to CRA, mail it out. We had to wait a number of weeks until everything is processed to make sure that everything was good. But in the end, the moral of the story, he was able to take back an additional $12,000 as a refund out of his 2022 tax return, which previously he didn't and he had missed on. So two things. First of all, you don't want to be doing that during tax season. If it wasn't that I was paying attention and somebody referred me and said like, hey, like there is an issue here, like there's something wrong with his file. And if I had not paid attention, we would have just done 2023 and it would have moved on and that's it. But if you do it throughout the year when it's not busy and it's not tax season, and maybe you're not with me, but you're with another professional or another accountant, having the information ready ahead of time and providing it to them is going to go a long way to get it done the right way. It is not the only client that kind of missed on figuring out which expenses are misallocated and are part of the ACB versus the current expenses. There are other clients who know about it, but they are asking their tax preparer to do it that way, and they just flat out decline. And they say, no, I don't have information. I don't have time to check it. So we're just going to file it as ACB. So that is something you want to be careful with and pay attention. Misallocations are very common. That is probably the number one thing that I see. And if you have the proper documentation and a good way of tracking and recording that, it could give you a lot of money back. And $12,000 potentially, that's like a quarter, maybe a third, potentially a half of a down payment. So that's your next deal right there. So you don't want to leave that money on the table. It's something that you want to take back when you can. We already pay the government more than enough. So that is a lot of money to leave on the table. The next story I want to tell you about is a friend of mine, another real estate investor. She did purchase a property towards the end of 2023, and I knew her. So I had stopped by the property to see it. We brainstormed together some ideas about, potential renos that she could do to make it rent ready. And during tax season, Maria gave me all her tax documents. And our company standard practice is that I assign the preparation to a tax specialist, and then usually it comes to me for final review before it goes to the client for signature. So after my specialist was done with her file, he sent it over to me, and I looked it over, and I was like, wait a second, like there's a property that I know about, and it's not in here. Why is it not in here? What's going on? So I called her up, and I was like, what happened to your property that you purchased in 2023? And she's like, oh, I didn't think that I need to submit that. I didn't find tenants until the next year. So I was like, no, like you did, like you purchased it in 2022. We need to include this information. So you can see how very easily, if the accountants as accountants or as tax professionals or even bookkeepers, if we don't know the information first-hand experience, there's no way to know. Like we need to gather it from the client somehow. And with the solution that I'm trying to provide is we want to find a way to make it kind of a little bit of foolproof. So that way we go through all your transactions throughout the year. And whenever we see something that doesn't fit in the current knowledge that we have, we try to find and ask questions. Is this a new property? Is this something new that's happened? So that way we can start including it in the file that we have running for you. And then when your year is finished, all the information will be right there. So you don't have to wonder or like, did I tell them about this? Did I not? Did I mention that I sold the property? Like, what if you forget to tell me that you sold it? That would cause a lot of issues if we are not informed that the property was sold. So how are we supposed to file for that? So definitely something that it's also from the other side. Like some people know about something that's happened and then they just don't know that it's possible to claim it, so they omit it, or they just don't know that it's necessary and they don't give us the information. So something that we want to avoid. The last story that I have is a bit of a horrific story. It's about a joint venture partner that came to me, and they had done 3 flips in the 2023 tax year. So I was systematically going through the information, and they had spreadsheets. They were using spreadsheets. However, they had some issues with their formulas and with the way that they were adding up the numbers. So after I kind of reviewed it from my end, I was like, well, something is wrong here. So I'm just going to add the numbers by myself. And I completed my calculations and I came up with a certain profit amount that was significantly less than the profit amount that they had. And I was sure that my numbers were right. I was going through it back and forth with them. And in the end, we agreed that my numbers were correct. The sad story is that because this individual had a joint venture partner, they had, in the end, it turned out that they had given 90% of the profits to the joint venture partner because they had incorrectly calculated their profits to begin with. So that is also something that we definitely want to avoid. As experts, we spend a lot of time to, prepare the properties, to work on the joint venture partnership, to prepare the documents, and to do a whole lot of work. But in the end, not being compensated for it is not good. And in this case, it was already months after the joint venture had finished. So as a result, they couldn't really recover it. I mean, they could, but that would be a little bit embarrassing going back and telling them, hey, like I made a mistake with how I calculated my numbers. I need to get some money back from you. So in the end, they had to eat the cost. And that is definitely not good. So again, another example of why do we want to make sure we're calculating everything correctly. We have a system. We're following every single number. And, you guys are busy. Everybody's busy. Work happens. Some you might have kids that go to hockey, or you might have a flood in one of your properties. While you're working on a file or something else that you have bookkeeping wise, you will forget. It's just inevitable. One day, sooner or later, there will be a mistake in your file. And the way to avoid that is to give it to a professional, someone that has nothing else going on but bookkeeping. We do this all day long. So we start from the beginning. We have systems, we have technology, and we have ways to check to make sure that there is nothing else wrong or missing from your file. And we provide you with the accurate reporting in the end. So let's talk about our solution. So remember what Wayne said earlier. You want to be running your business and you're essentially the CEO of your business. Your job is not to take care of the little things, and you don't need to know all the specific details about how things happen. Similar to a lawyer, you hand off your file, they give it back to you, or similar to an electrician, you send them to the job and you tell them what needs to be done, and then they deliver the work. Of course, you could do it yourself. You could probably prepare your own, legal agreements. You could probably prepare your own electrical. I don't recommend it. You could do your own plumbing. I also don't recommend it. But in the end of the day, bookkeeping is the same. You could do it yourself, or you could just outsource it. So the solution that we want to offer to the community is essentially you would just drop off the files to us and link your bank accounts. and that's literally it. By doing that, we would have the source of truth, essentially all the money coming and going. So that way we're able to work through the files and prepare the information as is necessary. We would organize it by property. We are going to provide you with your profit and loss reports. Most importantly, we're going to provide you with your adjusted cost base, or essentially we're going to track it through a balance sheet report. So that way you can have a proper balance sheet. Very often in unincorporated rentals or rentals that are owned in personal name, nobody thinks about recording a balance sheet. They usually just run their own spreadsheet that has the income and expenses, and that's it. That's where it ends. But that's not the whole story. And we want to use this wonderful method of double recording that was created specifically for our accounting profession. So we will prepare a balance sheet for you. And also, when tax time comes, we don't need any more information from you about your rentals. We already have the information. So we would just take that data and prepare your tax return right from it. Essentially, that is a full service solution. Something that you hand off to someone else and they take care of it, and you just get the results and you rip off the benefits. So I want to show you what our reporting would look like. This reporting is going to be from a fictitious file or a fictitious account. So the numbers are very rounded. And the numbers, though, are interconnected. So you're going to see this is the income statement, but we also have a balance sheet. So they speak with each other and the information is there. So first off, we have our income section. You can see it is broken down by the number of properties that this individual would have. Each of the little boxes could be expanded to give you more information about all the deposits that you would have received throughout the year as rents. And then, of course, we have the expense section. The interesting part about the expense section is that we are also going to show you what does your depreciation or appreciation look like, or do you have any unrealized gains or losses? So as each year goes by, when we have some type of source document, for example, a tax bill, or you've had an appraisal done because you wanted to get a line of credit or anything like that, whatever source document comes through our office, we would use it so that way we can update the gains or losses that are unrealized yet because you still own the property, but you will be able to see it directly in your report year over year or month over month, depending on how frequently we do the work for you. Okay, next is the balance sheet report. It's a pretty complicated report. It's a longer one, and one that I would say real estate investors are not as used to, but I'm going to point out to certain sections. So first, in the asset section of the report, we're going to show you your bank accounts. You might have one account or multiple accounts for the properties you have, but the numbers in these accounts will match exactly what your bank statements show. So that means everything that's gone through your bank statements would also be reflected in your reports. We're going to highlight issues with your accounts. In this case, rental one is in a negative balance. So what's going on there? Was there like a significant expense? Are you in overdraft? Or what do we need to do to remedy the situation? Perhaps you need to ask your joint venture partner for some more reserve funds. So we need to figure out what's going on there. The next section is your long-term asset. So that is essentially the properties that you have. In my first example here, we have rental asset one. So that would be the first property you bought. Maybe this is a townhouse. It was a $200,000 townhouse. In the previous report, you saw that we had a $25,000 appreciation. So where did that come from? That came because we looked at some kind of source document that told us that now the value of this property is $225,000. And the way we record that is by adding an appreciation line. So you can very clearly see what is it that you purchased the property for and what is it that it's valued now. In this case, we also have some improvements that were done throughout the years. if we drill down into it, I inputted some fictitious renovations for flooring, like upgrading it from carpet to LVP, or I think I also did a hot water tank upgrade or something like that. So it was the differences of those numbers that added to the $2,450. Now this is recorded in your balance sheet and is going to be there forever. But in reality, what happened to many of my clients, I see that they do some reno, and then 10 years go by, and the time comes to sell the property, and they're like, oh, I forgot about it. Like, I don't have the information about what renos I did, way back when I purchased the property. They do track it. They keep it in certain, folders on Google Drive, or they keep it somewhere, but when the time comes to actually use the information, they forget to bring it up. And this is why having a report like this would be super helpful, because you see all the information in one spot. And when the time comes to sell the property, there will be no questions and everything would appear in a single spot. In the next example, which is rental asset 2, I did an example of how it would look like if, for whatever reason, the client asked us to claim CCA. And capital cost allowance is a decision that we're not going to get into today. This is a complicated decision, and it is different for everybody. But in some situations, you do decide to take it. And when you do, that information only lives on your tax return in, page 75, in a very complicated schedule that is kind of difficult to read and difficult to comprehend year over year, to see how does it change, where is it, for which property is it even. So by taking that information, extracting it from your tax return and including it on your reports, you will have a very clear picture of, oh yes, on my rental too, I did claim CCA of X amount. And, when I need to make a decision and tax plan around what would the consequence be if I sold this property, then, it would be right there, and you can include it in your calculation and say, yes, I need to include my recapture about, $10,000 because now I'm going to sell this property for a profit. We also have an example of rental number 3. This one, I didn't touch it. I just left it as a purchase, but this is a joint venture purchase, and we're going to see later on how does it show in the report when we have money that we've collected from a partner. On the liability side, everybody has liabilities, and that the number one is deposits that we hold on behalf of our tenants. So whenever we bring in a new tenant, we obviously collect deposits, and sometimes when those deposits are returned, we see the expense come out, but we don't really know exactly why have we paid that money. And a lot of times it's because we've received a deposit. But sometimes when that money comes in and it's recorded incorrectly as income, it's not what we want to see, because you're paying double income. You're paying income on the deposit and on the first month's rent. So we want to make sure that we record it so that it goes into your balance sheet and not on your profit and loss statement. And that is a big mistake that many investors do, unfortunately. So we don't want to be paying taxes on the deposits that we collect. They're just a liability. It's money that we owe to our tenants and we will return later on. In our reporting, you could obviously drill down as well, and you can see the list of all the various tenants that you have and how much you recorded or you've collected from each one. So that would be available. And the next section is your mortgages. So all of the 3 properties that we talked about before have mortgages, and we would be updating this balance basically on a monthly basis. So we would be bringing down the balance by the amount of payments that you make every month. And once you receive your statement that shows how much your interest is versus how much your principal, we would make an adjustment. And then essentially your mortgage balance would be accurate and up to date all the time. So you would know that, hey, this is how much money is left over there. And the next and the most cool part is the equity section. And here's where we would record money that we collected from a joint venture partner. In this case, rental number 3 was 400,000. We purchased it for 400,000, and we needed the down payment money. That was 80 grand. So we found a joint venture partner that would be part of this deal, and they gave us 80,000 that were essentially part of this deal. That is money that in majority of joint venture agreements would usually be repaid to the partner first on a tax-free basis, because that is their own money to begin with. So by having it recorded as a separate line, as time goes by and you're making various payments, because you may not pay all 80 grand at the same time. You might pay, 10,000, then another 15, then another 20. This balance would change and it would be updated regularly, like as you make those payments. So then eventually you're going to see it go down essentially to zero. And at some point you'll be like, okay, so we're done with paying the partner, and now we can start drawing funds between the two joint ventures on the 50-50 agreement that we originally have. And right underneath that, you see retained earnings. That is 90,000. That would be the number that you would see as essentially money that you've contributed into your own rentals. So that's your own money that is kind of locked in a way into your rentals as the down payments that you've put into the three or the other two properties, I should say. So this is a complicated report. It is one that is not regularly seen with rentals. It does, you would see this in corporations. Corporations must submit a balance sheet report to the Canada Revenue Agency every year with their tax return. And my thought process was, if the corporations have to do it, there is a benefit. So how can we bring this and include it in, even though we don't have to submit it to CRA, we can still prepare it and have it. And the reason is there's so much data and so much information that goes on it. It is that data that gives you power. It is what makes you pick the right path forward. Are you going to sell a property or are you not? So having available the information at the fingertips of your hands, it gives you that power that you need, and to be in control of your own business, being the CEO of your business and running it smartly with data and numbers, not just by feelings. So this kind of concludes the product part and what are we going to offer you. So now let's talk about the cost, because nothing is free in life. So how much money are you going to need to spend for this? Our price is going to be very simple. We're going to charge you $35 per month for each one of your properties that you have part of this plan. If you pick the yearly plan, we'll give you $70 off. That kind of works out to 2 months. So you'll be paying for 10 instead of 12. And the cool part is, where are your savings coming from? So I tried to calculate and figure out how much money are you going to save by being part of this plan. So the first thing that I thought is, what is the average bookkeeping software cost out there? And there's various ones, but I think like a good average price was around $25 a month. So I put $300. $300 to $600 is how much bookkeeping software would cost you per year anyway, just to begin with. How much is your time worth? If you look at 12 hours a year times like maybe $50 an hour, $75 an hour, $100, like that would be different for everyone. And maybe Wayne will speak about this a little bit later on. How much is your time really worth? But I put a number of $750 for the year, and I think that's a fair number. Next, I contemplated getting this out of the presentation. It is how much you're going to earn on your credit card points, because we're going to let you pay with your credit card. And, on average, you get 2% back on your credit card. So maybe $8. So you get a little bit of savings there. We also have the tax savings piece. This cost is tax deductible. So although the face value is, $350 or $35 a month, whatever your tax rate is, that is essentially the discount you're gonna get from it. So rather than paying the government, you would be paying it to get the service that helps you get lower taxes. So it works out to anywhere between $87 or $105. The next was a big one. That was opportunity cost. How much money are you going to save by having someone else take care of it and opening more free time in your schedule to maybe do more deals? This is a very, very difficult number to come up with, but I put anywhere between $1,000 and $2,000. That's probably the value you're gonna get out of this. But in reality, this is invaluable. Like there is no price to it. And lastly is the cost of any reviews or audits from CRA. How much is it worth it to you to not have to deal with them? Because as I mentioned earlier, the letters are lengthy. The information that they require is a lot. You need to spend time doing it, then potentially open yourself up to more questions and more reviews for previous years. And usually that's how they work. It's a bit of a network. They test one person, and if he's connected to somebody else, then they go test that one, and then it just kind of goes in that circle and it spreads out. It's very difficult to deal with CRA. But I put this anywhere between $500 and $5,000 because this is also like very big range. It really depends on how big of an issue it was. But the reality is that this is also invaluable. There is no true cost to it. So in the end of the day, as our presentation said, our total cost anywhere between 2,600 to eight grand. So you could save at least $2,000 by having a professional taking care of your books, making sure that everything is done properly, and giving you the power to run your business a lot smarter and a lot faster with the more accurate information available. So I think with that, we're probably going to wrap up this part of the presentation.
I
And
gotta say, I think that you were awfully low on the opportunity cost.
Yeah.
Seriously though, it's this is actually funny because I was talking to Steve about this. I'm like, I should get this. I have another webinar or another training session that I've been wanting to do for almost a year now. And it's a training that I've done in the past. I just haven't done it in a very long time, and I just kind of need to revisit it again. But it goes over the cost or your hourly rate, basically. And each and every one of us that are here, there could be arguments made for each of us. Some people maybe a little bit newer, maybe your hourly rate isn't nearly as much, or maybe you don't think it's as much. And then some of the more experienced investors, if you set them on course and you take the leash off, a good entrepreneur, a good investor with an hour or 10 hours can make a lot of money, dedicated time towards a task. So by you spending whatever you said it was, like 10, 12, maybe 20 hours a year on this, that's 20 hours that a lot of newer and even some experienced real estate investors don't really have. Like, you got kids, you got baseball, you've got gymnastics, you've got work, you got stuff,
Floods, got floods all the time.
What'd you say?
You got flooding in your
Stop talking
property.
about floods. You're killing me, man. You're killing me. Like, give me post-traumatic stress. Floods, thank you. So like there's not enough time. And to be spending, an hour every month, on bookkeeping, and then probably not even doing it all that right. You got to think about, like, if you were to spend that hour on something else, how much money could you be making? You give me an hour, I can make some money in an hour. Right. So my hourly rate's in the high hundreds. Like, I don't really truly know. And if I said it was 2,000, you guys would probably look at me like, yeah, whatever, buddy. But like, I know the value of my time, and I'll be completely honest with you. It's more than $35 an hour. And even if I was to cheap out and try and do it myself, I'm probably not going to do a very good job. So it just makes total sense that, us as investors and entrepreneurs, we need to start changing the way that we look at things. And we need to start, like, I like what you said, you need to be the CEO of your business. You can't be running every department of your rental property business. You're already running marketing, and a lot of you guys are doing terrible jobs at marketing. Let's just be honest, myself included, right? You guys are already running the sales. You're running, like, you're trying to raise money. You're trying to find deals. You're running the service. Like, if you think about it, like, there's a lot of different hats that we have to wear as real estate investors. And the most successful real estate investors are the ones that are able to delegate and to hire out the stuff that they're not good at and the stuff that they shouldn't be working on. So that's why I think a bookkeeper is so incredibly important. So the opportunity cost, it could be in the thousands, tens of thousands. You know what I mean? That's one hour call you could be having with the next joint venture partner that could turn into $100,000 deal. It's a lot more than a few $100. I'm just being honest with you. So that's the way that I see it. And I think that's the way that you guys should see it as well. You got to start trying to,
And yes, don't forget that the final data is only as good as the information that's inputted into it. So if it's been inputted incorrectly or wrong to begin with, It's very easy to have mistakes on your tax returns. And usually the mistakes are not in your favor. They're in the favor of the government, and you're leaving money on the table. That's not what we want.
Yeah, absolutely. Okay, so we were debating about questions. We'll do a few questions here. I've got them all set up. I'll read them to you. First of all, we're talking about bookkeeping specifically for rental properties in your personal name today, but Finngo obviously does offer services for corporations as well. Just a little bit different.
Yes, it is slightly different. Usually corporations have a little more requirements, and like many bookkeepers out there, we already have a system and a pricing plan for corporations and things that target corporations. We have solutions for it. This is a solution that was missing from the market, so we are offering something specifically for rentals that are in your personal name. But
Okay.
if somebody has questions for corps, definitely let me know.
Okay. So Finngo obviously offers accounting and tax services as well. Obviously, we're talking about bookkeeping today, but you guys do help with taxes as well, right?
Yes. Yeah, we offer taxes as well. Yeah.
Okay. So I'm going to cap the questions now to what I got. Anything else, guys? If you have any additional questions, the best way is to reach out to everyone at Finngo. What's the easiest? Like client care at Finngo.com or Steve at Finngo.com? Steve?
Let's do Steve, just so that I get to it first. Yeah,
Yeah.
Steve@finngo.com.
Okay, perfect. I'll put that
Which is
information
right
back up again.
screen. So
What's that?
it's right there on the screen. It's being shared right now.
Oh, is it there? Okay, I can't see it. Okay, perfect. Yeah, reach out and just send them an email. And Steve, you also can set up a consultation as well if somebody wants to. Okay, perfect. Let's get through these questions. I know it's a long weekend, guys. It's Canada Day weekend. You guys want to get to the whatever you're planning on getting to. Okay, so good question. How secured is it to connect the bank accounts to the system?
Good question. I'll be very honest. We will be using a third-party software, QuickBooks Online, one of the industry leaders, one of the best software out there. I would say there would be no issues with security, and we can definitely go through the details of that if they chose to.
Awesome. Okay. What's the size of your team right now at Finngo?
Four.
Four.
We have 4 people.
And that includes bookkeepers
And
and
we're hiring.
and accountants.
Yes, we also have a CPA on the team. Yeah.
Nice. Perfect. Is there a limit to the number of transactions for this monthly base cost?
Yes, there is. Our limit is very generous, 150 transactions for the year for each
That's per
of the
property, right?
Yes.
Oh,
So
that's
I would say that's more than enough to cover the needs of anyone.
if you have more than 150 transactions for each property per month, then I'm
No,
what?
it's for the year.
Oh, okay, for the year. Okay, yeah, but even at that point, it's yeah,
Usually around four to
4.
10, per month. So
Yeah,
it's
yeah,
more than
that's
right.
more than enough for rental properties. It's not that many. Can I take the bookkeeping provided by Finngo and pass that on to my own personal accountant who handles my business and personal taxes currently and incorporate this into my personal tax return? Or would it be best to use one service provider for all accounting services? So can they use you and then you send it to their accountant?
Actually, that's a very good question, and it's good to cover it because we do have a lot of clients who still have long-term relationships with their CPAs that prepare the taxes, and we only take care of the bookkeeping.
Okay.
So yes, we do handoffs. So essentially, we close your year, we prepare a package, and we give it to your accountant. The accountant finishes the file and the taxes for you. And let me tell you, we get a lot of compliments about the files that we pass to accountants because we do taxes ourselves, so we make sure that all the information is necessary in there is available from the first time, and we don't have to go around in circles trying to gather the same things over and over again.
Okay, awesome. Is the $35 a month a base rate or some other tiered charges? Is there a limit on how many receipts you can submit for each property on this rate? Same kind of question.
It's just the 150 for the year limit. And because we know there could be fluctuations, we're not going to do it by month or whatever. We'll just look at it as a whole package. And if you went over, we'll charge you $2 per transaction extra. So if you go over like 10, that's going to be another $20. That's it.
Yeah. which, yeah, an extra $2 a month is pretty small. I honestly don't believe anybody would use that many transactions. Okay, last question from Patrick, and that was, what's the reason for the benefit to tracking annual appreciation? Good question.
So I would say that's the more of a personal benefit, and that's why it is labeled unrealized. It is more about you making the right decisions for the properties that you own. So you can compare them and you would know, okay, these are the years that it's kind of gone up, it's gone down. If I sell it, I'm gonna make a profit. And the question is how much? When you know how much it is, then you could take that number and estimate the taxes that you will be paying from that. And are you going to be deferring them or not? Or are you going to be taking CCA from somewhere else to offset it? Or are you going to make a contribution to your RRSPs to offset it? It's about making those important decisions. And very often, you try to do that, but you just take information from random sources and then you forget about something, or you forget a place or something that you've done. Like maybe you have appreciation, but you also claim CCA, or you also did some rentals, or who knows? There could be so many like things in there. And that's why having it all tracked all the time and having the full picture in one spot all the time is going to be the benefit. That, you just open it, you see it, and then you can make a decision.
Awesome. That's it. That's all. I like it. I like just being able to see it and just the organization of it. I'm an old-fashioned pen and paper kind of guy, but this just makes things easier just for accessibility. And then just if a joint venture partner has questions, I can pull it up very quickly. So it's very well organized, and it's as I mentioned earlier, it's perfect for real estate investors, right? It's a lot of thought and energy and creativity went into making this specifically, set up for real estate investors by a real estate investor. And I'm super excited for it. And I'm super excited to continue. I'm super excited to continue to keep sharing this, with the community. And again, just changing the industry standard. I think it's, I agree as an entrepreneur and as a business owner. I think that we should be, every penny counts. But this is one of those examples of like people think that they're saving money, but they're not actually saving money. And I want to really just shine a big spotlight on that. And we should start thinking more deeply about this and the money that we're leaving on the table by not getting it done professionally. So spread the word, guys. Whether you've already got it set up or you don't have it set up, share this with your friends and let them know. If anyone's asking for any services like this, let them know. Go Finngo,
We have a couple of minutes, and I'll also share. This week, I'm in Toronto for an accounting conference, and it was a 2-day conference. And a lot of the things that were talked about is about the advisory that your profession, bookkeepers, accountants, the tax preparers provide to their clients, and how can we reduce the amount of like manual data entry and inputting things, and here's your reconciled accounts. And yes, that's what our profession used to be about, but we're moving more and more towards advisory. What do these numbers mean? What more can we give you? Each month we can prepare these reports, but usually we want to start sending them out with some commentary about, hey, this is an area of concern, pay attention to it. So we're moving in that direction where we would be your most trusted advisor that you communicate with all the time, like someone that you kind of get you hear from regularly, at least monthly or quarterly. So definitely take advantage of it, because it's essentially free coaching that is available to you.
Awesome. There's one more quick question that just popped up. Someone sent me a message here. They said that, so if I don't have a rental property right now, but I'm planning on getting a rental property, should I be reaching out to you now, or should I wait till I have a property? What's your recommendation for something like that?
I would say reach out once you close on it, because we will probably start. Our first question is going to be, give us your purchase documents. So we're going to start from that point forward to basically record everything that you got.
Perfect. All right. Awesome. Steven, thank you so much for doing this. This is fantastic, and thank you, everybody else for being a part of this on the Friday before the long weekend. This is a lot of fun. And guys, the contact information is right there, and also in the chat there, you can see there's a special link specifically set up if you are ready to sign on and to do the engagement letter. Finngo.com/rentals plan. to get engaged engaged with Steve. Sorry.
I'm already engaged. I'm sorry.
Or just go to fingo.com and you can set up a consultation as well. Email. It's all there, guys. Thank you guys again. Have a good night.
Have a great long weekend, everyone. Thanks for.